Hi there. In this video, we'll cover 6 practical tax efficiency actions UK homeowners should consider before the tax year ends.
Welcome to this explainer. Look, if you're a UK homeowner, a property investor, or maybe a higher rate taxpayer, you are navigating a tax landscape right now that is honestly packed with structural freezes and looming legislative overhauls. We're staring right down the barrel of the 2026-27 tax year, which, as we know, ends strictly on the 5th of April. And honestly, if you don't take action, you are literally just leaving money on the table. So today, we're giving you the absolute essential guide to 6 crucial tax efficiency actions you need to lock in before that deadline hits. Because in the UK tax system, these allowances are strictly use it or lose it.
Picture this real quick. You've worked incredibly hard this year, right? And you've pushed your earnings just over that £100,000 mark. You're probably thinking, okay, I'm just paying the 40% high rate of tax. But did you know you might actually be walking blindfolded into a hidden 60% effective tax trap? Yeah, 60%. Add to that a frozen £3,000 capital gains allowance that's just quietly draining your household wealth in the background. The harsh reality is, without a game plan, the tax man is keeping way more of your hard-earned money than you probably realize. Every single pound that slips through the cracks of a missed allowance, that's a pound that could have gone towards your family's future, a new property investment, or even just bumping up your retirement fund.
And hey, that is exactly why we're here today. We're bringing you this explainer in partnership with My Tax Accountant, or MTA. MTA is a highly trusted, expert UK accounting firm, and they are completely dedicated to helping individuals and business owners figure out and really master tax compliance. If the anxiety of these hidden tax traps has you a bit worried, consider MTA your go-to solution. They're going to be our guiding light today as we break down these really complex rules step by step, making sure you have the exact knowledge and strategy to confidently protect your wealth. So, here is our countdown framework before that April 5th deadline strikes. We're covering the April 5th tax trap, pensions and allowances, transfers and Form 17, green energy and capital gains, property allowances, and finally, exactly how to secure your wealth today. All right, let's dive straight into step 1, the April 5th tax trap. Let's look at the environment we're actually operating in. It really all boils down to this phenomenon called fiscal drag. It's kind of like trying to walk up a down escalator, you know? Inflation naturally pushes your nominal income up into higher tax bands, but the government keeps your tax allowances completely frozen. Here in the UK, the personal allowance of £12,570, along with other key tax thresholds, have been frozen all the way until April 2031. It's basically a stealth tax. It quietly forces you into higher tax brackets just to keep pace with the cost of living, without you actually feeling any richer. Your purchasing power stays exactly the same, or even drops. Yet on paper, you suddenly look wealthy enough to get hit with substantially higher tax rates. So, how on earth do we fight back against this fiscal drag? Well, that brings us to number 2, pensions and personal allowances. Okay, let's unpack that shocking 60% figure I mentioned earlier. If your adjusted net income lands anywhere between £100,000 and £125,140, you are getting hit with a 60% effective marginal tax rate. Why? Because for every £2 you earn over £100,000, your £12,570 tax-free personal allowance is clawed back by £1. By the time you hit £125,140, your allowance is just gone. Completely vanished. So you're paying 40% tax on the income itself, plus another 20% effective cost because you've lost that tax-free allowance. It is absolutely one of the most punishing quirks in the UK tax system. Imagine landing this amazing £10,000 bonus at work, only to realize the taxman is pocketing $6,000 of it before it even hits your bank account. No thank you. But good news, there's a pretty brilliant mathematical fix for this. Let's look at some numbers. Say you're pulling in a gross income of £115,000. You've already lost a massive chunk of your personal allowance. But if you make a net pension contribution of £12,000 before April 5th into a Relief at SIRS scheme, the government actually tops that up by 25%. So that instantly becomes a $15,000 gross contribution. Because of that, your adjusted net income suddenly drops right back down to exactly £100,000. You instantly win back your full personal allowance, saving $3,000 in tax right on the spot. And quick professional tip for you here, this exact same strategy works to sidestep the high-income child benefit charge, which aggressively claws back child benefits when your income crosses that $60,000 to $80,000 threshold. So taking action here literally solves 2 massive headaches at once. Now, here's where we have to look at the bigger picture, something called intertemporal tax planning. Fancy term, but it basically just means balancing today's wins against tomorrow's costs.
While snagging 60% tax relief today is absolutely fantastic, there are some huge legislative changes looming on the horizon. Starting from the 6th of April 2027, unused defined contribution pension pots are going to be brought right into the scope of inheritance tax, or IHT, at a whopping 40%. Historically, pensions were this brilliant tax-free way to pass wealth down to your kids outside of your estate, but soon, that changes entirely. So you have to strategically weigh the immediate income tax relief you get right now against that future 40% IHT hit on your estate down the line. Moving right along to our next actions. Number 3, spousal transfers and Form 17. If you are married or in a civil partnership and you own property, this one is a real game changer for building long-term household wealth. Managing how your property income is taxed between the two of you is incredibly powerful. The UK tax system is progressive, right? So if one spouse is paying tax at 40% or 45% and the other is only paying at the basic 20% rate, or maybe has no income at all, it makes total sense to allocate your rental income to the lower-earning spouse. Imagine one of you is a high-earning director and the other took a career break. Just shifting those rental profits down to the basic rate band could save you thousands every single year. But there is a catch. Under UK rules, HMRC automatically assumes that income from jointly held property between spouses is split 50-50, and they assume this regardless of who actually put up the money for the property. So to override that automatic 50-50 assumption, you have to follow some very specific steps. Step 1, you execute a legal document called a declaration of trust. This defines your actual beneficial ownership shares. Say 90% goes to the lower earner and 10% to the higher earner. Step 2, make sure the property is legally registered at the land registry as tenants in common. Step 3, you absolutely must submit HMRC Form 17. And the clock is severely ticking on this one, folks. Form 17 has to reach HMRC within exactly 60 days of signing that declaration. And a major warning here straight from our experts at MTA. HMRC strictly rejects any attempt to backdate these documents. It only applies to income generated from the date of the declaration onwards. So whatever you do not sign this and just leave it sitting in a desk drawer. All right, shifting gears to our fourth area, green energy and capital gains. Thinking about making your home a bit more energy efficient, maybe installing some solar panels to catch whatever bits of British sunshine we actually get? Well, timing here is absolutely everything. The government is currently offering a really beneficial temporary 0% VAT rate on energy-saving materials. We're talking solar panels, battery storage, air source heat pumps. But this zero rate is only confirmed until the 31st of March 2027. After that, it snaps right back up to 5%. So if you're planning these upgrades to boost your property's value or its EPC rating, locking in those contracts and getting the installation done before that sunset date is a guaranteed way to save 5% on what is essentially a major capital expense. Now, what about selling assets? Did you know there's actually a perfectly legal way to double your frozen £3,000 capital gains tax allowance? It's brilliant. If you're selling a divisible asset or maybe shares in a property portfolio, you can creatively split the transaction right across that April 5th boundary. So you exchange one contract on the 4th of April, which uses this year's £3,000 allowance. Then you simply exchange the second contract on the 6th of April, tapping into next year's £3,000 allowance. For a married couple holding assets jointly, this strategy literally doubles your combined allowance to £12,000 entirely tax-free. Just keep in mind, for residential property, you've got a strict 60-day deadline from completion to report and pay that CGT to HMRC. Okay, we're on the home stretch here. Number 5, maximizing property income allowances. You basically have two mutually exclusive statutory reliefs you can claim here. The rental room scheme is great. It lets you earn up to £7,500 tax-free just for letting out a furnished room in your main home. Alternatively, the property allowance gives you a flat £1,000 tax-free for minor property income, like if you're renting out your driveway. But here is a massive professional tip. Beware the joint owner trap. If you own your home jointly with your spouse, that £7,500 rent-a-room limit is automatically halved to £3,750 per person. So imagine a lodger pays £6,000 a year straight into your joint account. You have both just inadvertently exceeded your individual £3,750 limits, and guess what? Now you both have to file tax returns. Finally, if you are a landlord using cash basis accounting, which by the way is the default if your gross property income is under £150,000, you record your expenses when they are physically paid. This gives you a really fantastic opportunity to take control of your tax bill. You should strategically schedule revenue expenses to happen right now. Pay for that boiler servicing,
get those roof tile repairs done, or redecorate between tenancies before the 5th of April. By actively bringing those physical cash payments forward before the deadline hits, you legally depress your taxable profit for the current year, immediately shrinking your upcoming tax bill. So, what does this all mean? Let's wrap it up with our final section. Secure your wealth today. Because just knowing these rules isn't enough, right? You have to execute. Let's do a super quick recap of the 6 actions you need to take before the deadline. 1. Offset that brutal 60% marginal tax trap by grossing up your pension contributions. 2. Ensure your spousal income splits are legally backed by a declaration of trust and Form 17 within 60 days. 3. Balance today's pension tax relief against those impending 2027 inheritance tax rules. 4. Act early on green energy to lock in that 0% VAT. 5. Split your capital gains sales across the 5th of April to double your frozen allowances. And 6. Time your property expenses perfectly on a cash basis and watch out for that joint owner trap. Look, taking proactive steps before the April 5th deadline is literally the only way to shield your household wealth from fiscal drag. Do not leave this to the last minute. If you need help tailoring any of these strategies to your specific situation, reach out to the experts at My Tax Accountant. You can give them a call at 0208-570-8531, shoot an email over to info@mytaxaccountant.co.uk, or just visit www.mytaxaccountant.co.uk. And hey, please make sure to subscribe to our channel for more targeted explainers just like this one. Please note this explainer is for informational purposes only and does not constitute financial advice. Always consult a professional for your unique circumstances. I'll leave you with this final thought. The government has deliberately frozen your tax allowances until 2031. So, are you going to let inflation quietly dictate your wealth, or are you going to take action today to protect it? Thanks so much for joining us, and we'll see you next time.